Welcome to Tensor Lens. This is your channel for truly hardcore tech and investment analysis. So if you're tired of all the surface-level noise and you're looking for something deeper, you are definitely in the right place. Today, we're going to decode the new physics of the AI-driven market.
You know, our whole philosophy here is pretty simple. The market isn't just a list of tickers on a screen. You have to think of it as a physical system, a high-dimensional vector field where every stock is a point with its own momentum and direction. And the old maps we use to navigate this system, they're totally obsolete. And why is that? It's because the most dominant players out there are no longer human. They're silicon-based agents, and they operate at the speed of light, and they obey a completely different set of laws.
So, to really understand this new landscape, we first have to master the new governing equations of value. It's time to forget about simple price charts. We've got to start thinking in terms of energy states.
Okay, first up, we have intrinsic value, or IV. The best way to think about this is as the potential energy of a company. It's all that stored value, right? The true worth based on its fundamental ability to generate cash way out into the future, completely separate from today's market noise or whatever the current sentiment is. It's like a silent gravitational force.
And then on the other side, we have market value, or MV. Now this is the asset's kinetic energy. It's that chaotic, observable price you see flashing on your screen every nanosecond. And it's driven by the heat of all these external forces. You know, news, liquidity flows, mass psychology. This is the system in motion.
So the gap between these two states, potential and kinetic, that is where every single investment opportunity is born. I mean, a rational investor buys when the kinetic energy is low and the potential is high. But here's the problem. AI is now calculating both of these values in real time, and that is fundamentally changing the nature of that gap.
Now, the classical tool for translating future potential into today's intrinsic value is the discounted cash flow model. You're looking at it right here. This equation is the bridge. But what's happening now is that AI is acting like a perturbation force on the entire system. It is actively altering every single variable, from the projected cash flows to the discount rate, and especially that last part, the terminal value, which is just a company's assumed value stretching out into perpetuity.
Which, of course, brings us to the most critical question. If the equations themselves are changing, who, or maybe I should say, what, is actually running the calculations? And the answer to that takes us from the theory of finance straight into the new reality of the market's microstructure.
What we're witnessing right now is nothing short of a phase transition. The market is literally shifting from a kind of viscous, human-dominated liquid state to a high-energy, low-latency plasma state that is governed almost entirely by artificial intelligence.
And the scale of this transition, it's just staggering. By late 2025, it's estimated that 89% of all global trading volume will be handled by AI and algorithmic systems. Let that sink in. That means for every 10 trades happening out there, 9 of them are kicked off by a machine. So they're not just participating in the market anymore. For all practical purposes, they are the market.
But look, these are not the simple, rules-based algorithms from the last decade. We've evolved way past that. Legacy high-frequency trading bots, they were deterministic. They just followed simple if-then logic. But today's agentic AIs, they're probabilistic. They're ingesting completely unstructured data. Things like the audio from earnings calls, satellite imagery of parking lots, even GitHub commits, and they reason about the second-order effects. This is a complete quantum leap in capability.
And of course, a leap like that brings brand new systemic risks. So when you have all these agents trained on similar data, all converging on the same idea at the exact same nanosecond, you get what's called hallucinated herding, a consensus based on flawed AI reasoning. You also get a liquidity paradox, where the appearance of a deep market can just vanish instantly as all the agents pull their orders at the same time. This is what sets the stage for a cognitive flash crash, a market drop that's not driven by bad news, but by emergent AI behavior.
Okay, so to make this all a bit more concrete, let's ground the theory in a real-world, high-magnitude event: Google's recent re-rating in the market.
So throughout 2024, the whole narrative was that Google was lagging behind in AI. To fight back, they executed this absolutely brilliant strategic deployment of their new Gemini 3 model in late 2025. And this wasn't some flashy keynote speech. No, it was a deliberate, multi-stage rollout that was designed from the ground up to prove their engineering dominance and reassure the market.
And the market's reaction? It was immediate. As all those agentic traders parsed the technical specs and confirmed the massive leap in capability, the stock saw a textbook step function re-rating. We're talking a 3% jump in a single session, which cemented a 55% year-to-date gain.
Just like that, the potential energy of Gemini 3 was instantly converted into the kinetic energy of market value.
All right, now let's peel back another layer and look at the physical world, because software is really only half the story. The defining conflict of this entire era is the high-stakes hardware war happening right now between Nvidia and the tech giants themselves.
The central economic conflict here is actually pretty simple. To run AI, you need GPUs, and for years, that meant you had to pay the Nvidia tax. We're talking gross margins that exceed 75%. Well, this is a massive transfer of wealth that the most capitalized companies in history are now spending hundreds of billions of dollars to stop.
And this right here, this is where the battle for trillions in market cap is actually being decided. It's in the deep engineering specs. When you compare Nvidia's B200 to Google's TPU V7, which has the codename Ironwood, you see that the war isn't just about raw compute power, which is pretty much a dead heat. The real war is won in how you connect all the chips together.
And this is the game changer. Google's big structural advantage is something called optical circuit switching. So instead of connecting chips with copper wires that get hot and waste energy, Google uses these microscopic mirrors to route photons, actual particles of light. This isn't just a slightly better chip, it is a fundamental advantage based on the physics of photons versus electrons, and it allows them to build these massive, more efficient supercomputers.
Now, this reality creates a huge risk for Nvidia. Look at this, nearly half of its revenue comes from just a tiny handful of hyperscalers. And these companies aren't just Nvidia's biggest customers anymore. They are now its biggest competitors, and they are actively working to eliminate their dependency. This poses a direct existential threat to Nvidia's terminal value.
And the sheer scale of this hardware war is almost impossible to comprehend. The projected capital expenditure on AI infrastructure by Big Tech is set to blow past $405 billion in 2025 alone. I mean, this is without a doubt the largest infrastructure build-out in all of human history. So let's bring this all together. What is the coherent worldview, the tensor perspective, that you should really take away from all this?
Well, it really comes down to three core pillars. One, the fundamental physics of valuation has changed. AI has literally altered the equation. Two, the hardware war is the defining economic conflict of our time, and the winners are going to be determined by physics and efficiency at scale. And three, this new agentic era of trading brings incredible efficiency, yes, but it also brings new, tightly coupled systemic risks that we're just beginning to understand.
And this really is the core thesis here at Tensor Lens. Forget the daily noise, forget the hype, forget the sentiment. In the long run, it's the physics of the underlying system. The efficiency of the silicon, the latency of the network, the cold, hard logic of the code that always dictates the economics of the market.
Look, the market is now a single, tightly coupled supercomputer, and it's running on machine time. So the final question is pretty simple. Are your investment models prepared to operate at the speed of light? To stay ahead of this massive phase transition, make sure you subscribe to Tensor Lens for more deep analysis like this.